You know, a lot of people look at the price of gold today and say, wow, it's over $3,400 an ounce. That's wild. It's skyrocketed. But let's take a step back. Back in 1933, gold was just $20.67 per ounce. So what does that really tell us? Did gold suddenly become way more valuable? Not quite. What it actually tells us is that the dollar has lost a staggering amount of purchasing power. It's not that gold has gone up, it's that the dollar has gone down. We've been trained to think in terms of prices rising, but in reality what's happening is our currency is losing value. That's a key distinction. And the truly alarming part? Once the broader public wakes up to this, once it clicks that the money in their pockets buys them less and less, not just because of inflation, but because of systemic devaluation, then that currency is on borrowed time. Hey everybody, this is Kaiser Johnson with Liberty and Finance. Welcome back. We're bringing you the Miles Franklin weekly specials for the week of July 21st through July 28th, 2025, available while supplies last. Let's get into what's on offer. First up, we've got an amazing deal on pre-1933 US gold coins. You can pick up MS 62 $20 Liberty coins or MS 63 $20 St. Gordon's coins for just $90 over melt value. That's right, $90 over melt to own a real piece of American history. These coins aren't just beautiful, they're a direct tie to a time when money actually meant something. Next, we have 1 ounce backdated platinum eagles at only $270 over the spot price. Platinum is a metal that doesn't always get the spotlight it deserves, but in terms of scarcity and industrial use, it's powerful stuff. And finally, our dealer's choice 90 US Mint silver dimes and quarters, also known as constitutional silver, are just 65 cents over spot per ounce. These are the coins that circulated when your grandparents were kids. Real money you could hold and spend. Now they're sought after as a hedge against currency decline. To order any of our specials, or if you just want to learn more about the other precious metals options available, give us a call at 1-888-881-LIBERTY. That's 1-888-8154237. We take calls after hours and even on weekends. We're here for you and happy to help. Now, let's pivot to something our audience always looks forward to. An in-depth discussion with one of the sharpest voices in global finance. We're joined again by our good friend and returning guest, Alistair MacLeod. Alistair is a seasoned former bank director and a widely respected head of research, and we're speaking with him on Thursday, July 24th. Alistair, welcome back. It's always an honor to have you here. Thank you, Kaiser. Always a pleasure. Alistair, our viewers have been closely watching the metals markets lately. Silver, in particular, has been showing some real strength against gold. Both metals have been holding steady and even rising over the past quarter, and especially in the last couple of weeks. I wanted to ask you about an article you recently wrote. In it, you explored whether this run-up in metals prices might be followed by a sharp correction. What did you uncover when you dug into that analysis? Well, Kaiser, as always, when it comes to any commodity, especially metals, volatility is part of the game. That said, I decided to take a long-term look, especially at silver. I compared silver's recent behavior to that of industrial base metals and assembled a price basket that goes all the way back to the year 1900. What's revealing is what happens when you price those metals not in dollars or pounds, but in gold. You see, gold has an extraordinary quality. Its purchasing power has remained largely stable over decades, centuries, even millennia. That's because gold is accepted globally as money, and unlike Bitcoin or fiat currencies, its supply expands at a slow and relatively predictable pace, often in line with global population growth. So when we price something like industrial metals in gold rather than fiat currencies, we get a much more accurate picture of what's actually happening in terms of real value. Kaiser, that's a crucial insight, shifting the perspective from dollar-based thinking to gold-based valuation. Exactly. When we use gold as the yardstick, what we see is pretty remarkable. From the start of the 20th century, so that's over 125 years, we've seen that the purchasing power of a basket of base metals priced in gold has stayed surprisingly stable. Until recently. Right now, that same basket is priced at a 77% discount to where it was in 1990. That is a massive undervaluation, and history shows us that it doesn't stay down there forever. It always reverts to the mean, sometimes overshooting, sometimes undershooting, but eventually it snaps back. So what that tells us is this. If you're holding metals right now, or thinking about investing, you could reasonably expect a 3- to 4-fold increase in base metal value over time, even before accounting for the further erosion of fiat currencies. That's a big deal. So not only are we seeing base metals severely underpriced in gold terms, but we also have the tailwind of fiat currency debasement pushing the whole sector forward. Exactly. It's a double tailwind. And it's not just industrial metals we're talking about. If you look across the board at other commodities, energy, agricultural goods, raw materials, they're all sending the same message. The price suppression we're seeing is artificial, temporary, and unsustainable. When that dam breaks, we'll likely see consumer prices across the board start moving significantly higher over the next 5 to 10 years. Governments may keep trying to massage inflation numbers, but they can't fight reality forever. Let's bring it back to silver for a second. You mentioned that silver right now is being priced more like an industrial metal with no monetary premium attached. That's correct. Silver is being treated by the markets like it's just another industrial input, on par with copper or zinc. But that's going to change. See, gold is extremely underowned, and it's starting to get noticed again, even if slowly. As average investors begin catching on, many of them, especially at the margin, are going to look at silver as the more affordable entry point. They'll say, gold's already had its big move, but silver hasn't. And when that sentiment spreads, silver demand will explode. Silver is already moving up. In fact, it's been on a clear upward trend since I wrote that article, and I expect that to continue. And gold. Gold's been consolidating. It's held its ground remarkably well, just sort of moving sideways for the past 2 or 3 months. But from a technical standpoint, that's not a bad thing at all. It's actually forming a classic setup for the next breakout. In technical terms, what we're looking at is a pennant or symmetrical triangle. These patterns usually have 5 legs down, up, down, and we're currently on that last down leg. Coincidentally, this pattern is aligning perfectly with the upcoming options expiration on the August gold contract, which happens Monday. So I wouldn't be surprised if we see gold dip slightly, maybe 1 or 2%, but that would just be noise. It's not meaningful in the broader trend. That's a great breakdown, and it's helpful to understand the context behind those movements. Let's dig a little deeper here, beyond just the price action. You've mentioned before that metals as a whole, not just precious metals but also base metals, are severely underpriced, and that this mispricing is now creating some friction in the paper markets. Yes, exactly. That underpricing is causing what I would call indigestion in the futures and paper trading world. When you look at the performance of commodities this year, platinum, palladium, copper, silver, gold, they've all been among the strongest performing assets. That's not a coincidence. This strength is a sign of just how distorted pricing has become over the years, especially due to paper derivatives and short-selling strategies. But now the physical reality is catching up, and that's leading to pressure in the markets. And for those people sitting on the sidelines, waiting for some big correction to swoop in and buy metals cheaper, well, I hate to say it, but I think they're going to miss it. They're just going to miss the train, right? A lot of folks still think they'll have time to get in, that there will be a dip, or that it'll come back down again. And that's the mindset that keeps people paralyzed. But here's the truth. Gold and silver are both very underowned. Let me give you some perspective. Globally, total portfolio assets across the entire financial world were estimated at around $270 trillion in 2023. That includes pensions, retirement accounts, institutional funds, and so on. Now, when you look at the share of that wealth allocated to gold, the number is shockingly low. If you take gold exchange-traded funds, ETFs, as a proxy for portfolio interest in gold, those ETFs account for less than 2% of all global portfolio assets. And that's being generous. That's astonishing. Less than 2%? Yep, and there's a reason for that. Most institutional investors operate under regulatory guidelines that make it difficult, if not impossible, to hold physical gold. It's not classified as a regulated investment in many jurisdictions. So, if a fund manager wants to add gold to a portfolio, they're often forced to buy a substitute, something like a gold ETF, just to stay within the rules. But the bigger point here is that gold is still largely off the radar in the Western financial system. In places like Asia, where people have a much deeper cultural understanding of gold's role as real money, there's more private ownership. But in the US, in Europe, in the UK, in Australia, in Japan, gold is vastly underrepresented in investment portfolios. So if we do get a financial crisis, a real shake-up, and people start selling assets to raise cash, they won't be selling gold. They don't have enough of it to sell. They'll be liquidating other things. And that's one of the reasons I believe the downside risk in gold is minimal from here. The fundamentals are just too strong. That really ties back to what you said earlier. This isn't so much about gold going up, it's about the dollar going down. And that change in mindset, switching the frame of reference, is crucial. Absolutely. People still measure their wealth, their preparedness, their retirement savings, all of it, in dollar terms. And it's understandable. You earn dollars, you pay taxes in dollars, your bank account is in dollars. So your baseline risk-free position feels like it's in cash. But that is a complete illusion. The dollar is not a store of value. It is a credit instrument, and its value is entirely dependent on your faith in the Federal Reserve and, by extension, the US government. And let's be honest, how much faith should people really have at this point? That's a great point. You've also said that foreigners tend to spot the cracks in a currency before the people living in that country do. Yes, and there's a reason for that. If you're a British investor, for example, and you're looking at US assets, you're doing your accounting in pounds. You're thinking in pounds. Your risk-free position is pounds. So when the dollar starts losing value, you feel it much more quickly. You see that risk show up on your balance sheet immediately. But if you're a US resident, your whole world is denominated in dollars. You don't notice the deterioration until it's too late. You think in terms of price increases. Your grocery bill goes up, your rent goes up, your car insurance goes up, but you don't question the currency. You just assume prices are rising. You call it inflation, but that's not the root cause. What's actually happening is your currency is losing value. That's a subtle but crucial distinction, and it's one that very few people understand. The term inflation has been hijacked to mean rising prices, but real inflation is about an increase in the quantity of credit. That's what drives prices up. Prices don't inflate. Currencies devalue. So when we say prices are going up, what we really mean is the dollar is buying less. Again, go back to 1933. $20.67 bought you an ounce of gold. Today, that same ounce costs you over $3,400. Gold hasn't changed. What's changed is the value of the dollar. And we've been in a slow-motion crisis ever since. That's a hard pill for many to swallow, especially for those who've been raised to believe that a savings account is a safe place to preserve wealth. Exactly. I had a call just last night from someone who said, "I finally see it. I've got to get my money out of the bank and into silver. Not tomorrow, now." That realization, that light bulb moment, is huge. It's a mental shift from the old thinking of it's safe in the bank to, I need to move it into something real. Something tangible, something that holds value. And once that shift happens on a large scale, it's game over for fiat currencies. That's when confidence collapses, and that's the final act. Let's zoom out a bit. People often look at the US dollar compared to other currencies, the euro, the yen, the pound, and they'll say, well, the dollar is still strong. But is that really the right way to think about it? Not at all. That's another illusion. All fiat currencies are in the same sinking boat. The US dollar, the euro, the yen, the pound, they're all losing value. Some are sinking faster than others, sure, and sometimes the dollar might look strong simply because everything else is falling even faster. But they're all falling. This is why we say it's not about gold going up, it's about all fiat currencies going down. That reminds me of a metaphor you've used before. A bunch of skydivers in freefall. They're all dropping at different speeds, but they're all dropping. That's exactly right. It's like watching skydivers trying to judge their altitude by looking at each other. Oh, I'm falling slower than that guy, so I must be doing okay. But they're all heading toward the ground. And unless they pull a parachute, unless they shift to real, tangible assets, they're going to hit bottom. And here's the thing. Gold, silver, real commodities, those are the parachutes. That's powerful and very visual, and I think it really hits home, especially for people trying to figure out how to protect themselves and their families. So let's talk about that parachute, about protection and preparedness. For people listening who are new to all of this, or maybe still on the fence, what are some practical first steps they should consider? I mean, we talk about gold and silver, but what does that actually look like on the ground level? That's a great question. And honestly, the most important thing is to just get started. Don't worry about buying the perfect product or timing the exact bottom. The point is to begin shifting some of your wealth, whatever you can afford, into real assets. Start with silver if gold feels too expensive. Even a few $100s in physical silver puts you miles ahead of the vast majority of people who still have everything tied up in fiat paper. Silver is incredibly undervalued right now, and it gives you that tangible connection to real value. You can hold it. You can feel it. It's not someone else's promise, it's yours. From there, once you've got some silver, you can begin looking at gold, maybe even platinum, depending on your goals and your financial situation. But the key is to take action. The longer you wait, the more purchasing power you lose. Period. I love that. Just start. Don't overthink it. I've talked to so many people who waited for years, waiting for the perfect entry point, and they ended up watching prices double while their dollars sat idle in a savings account, earning next to nothing. Exactly. And there's a psychological component to this too. When you buy metals, you're not just protecting your purchasing power, you're also reclaiming a sense of control. You're stepping out of the system that depends on you not understanding how it works. The modern banking and monetary system is designed to keep people in a constant state of dependency and confusion. Most people don't understand how money is created, how inflation really works, or what central banks are actually doing. But once you start learning, once you take that first step, everything starts to make sense. It's like that moment in The Matrix when Neo takes the red pill. Suddenly, you see the code for what it really is. Exactly. You realize that the entire system runs on perception, and that perception can be manipulated. But reality has a way of reasserting itself. And gold, silver, real things, they anchor you to that reality. Let me put it this way. You can't manipulate a gold coin. You can't print more of it. You can't send it to zero with the stroke of a keyboard. It has value because it is value. That's something most people haven't encountered in a long time. That really highlights the difference between wealth and currency. Most people think those are the same thing, but they're not. Alistair, absolutely. Wealth is something that sustains your life: land, resources, food, energy, labor, capital, productive assets. Currency is just a tool we use to exchange wealth. But when the tool breaks, and all fiat currencies eventually do, you want to be holding the real thing. And here's something else. We're heading into a new phase globally. The geopolitical landscape is shifting. The BRICS plus countries are actively working to move away from the US dollar. Trade is increasingly being settled in local currencies or in gold. Central banks around the world are stockpiling gold at a record pace. These are not random events. These are deliberate moves to escape the dollar-centric system that has dominated for nearly 80 years. And once enough players walk away from that table, the game changes. For everyone. That's a critical point. We're not just talking about economic theory here. These are real tectonic-level changes taking place on the world stage. And if you're not paying attention, you could wake up one day and find the rules have completely changed. Precisely. Most people in the West are still living in the shadow of the post-World War II dollar order. They think, well, the US will always be on top. The dollar will always be the global reserve currency, we'll always be able to borrow and spend. But that era is ending, and you don't want to be the last one to realize it. Couldn't agree more. And the timing really couldn't be more urgent. We're already seeing cracks in the banking system. People in the US are starting to face what folks in other parts of the world have dealt with for years: declining savings, wages that don't keep up, soaring food and energy costs. These aren't just signs of inflation. They're signs of monetary decay. Well said. And here's the thing. Once that confidence is lost, it doesn't come back easily. Currencies collapse when the public loses faith, not in the central bank, but in the idea that the money in their wallet will still buy something next year. That's how it always happens, and that's why I say, don't wait for the headlines to tell you it's time. By the time it's on the front page, it's already too late. That's really powerful. Before we wrap up, is there anything else you'd like to leave our viewers with? Just this. Stay curious. Keep learning. Take responsibility for your own financial education. No one is going to do it for you. The system isn't built to protect you, it's built to perpetuate itself. And if you do one thing this week, go out and get some real money, gold, silver, whatever you can. It's not about getting rich quick, it's about not getting wiped out slowly. Protect your family, protect your future, and don't wait until it's too late. Beautifully said. Alistair MacLeod, thank you as always for your insights, your clarity, and your time. Thank you, Kaiser. Always a pleasure. And that wraps up our conversation today. If you're ready to take action, remember, we've got this week's specials running through July 28th, or while supplies last. Just give us a call at 1-888-1-LIBERTY. That's 1-888-154-237. We're here to help you navigate all of this and make the move into real wealth on your terms. Whether it's gold, silver, platinum, or just a conversation about how to get started, we're honoured to walk this journey with you. Until next time, this is Kaiser Johnson with Liberty and Finance, reminding you to stay strong, stay prepared, and stay free.